The economy of New Zealand is a mixed economy that depends greatly on international trade, mainly with Australia, the European Union, the United States, China, South Korea and Japan. The closer economic relations agreement with Australia means that New Zealand's economy is closely aligned with the Australian economy. New Zealand's economy has a sizable service sector, accounting for 63% of all GDP activity in 2013. Large-scale manufacturing industries include aluminum production, food processing, metal fabrication, wood and paper products, mining, manufacturing, electricity, gas, water, and waste services accounted for 16.5% of GDP in 2013. The primary sector continues to dominate New Zealand's exports, despite accounting for 6.5% of GDP in 2013. The major capital market is the New Zealand Exchange, known as the NZX. As of November 2014, NZX had a total of 258 listed securities with a combined market capitalization of $94.1 billion. The currency is known as the New Zealand dollar, which is also the currency of 5 Pacific Island territories. The New Zealand dollar is the 10th most traded currency in the world. Overview. The New Zealand economy is usually seen to be successful. It has been ranked first in the world for social progression, which covers such areas as basic human needs, foundations of well-being, and the level of opportunity available to its citizens. However, the generally positive outlook includes some challenges. New Zealand income levels, which used to be above those of many other countries in Western Europe prior to the crisis of the 1970s, have dropped in relative terms and never recovered. As a result, the number of New Zealanders living in poverty has grown and income inequality has increased dramatically. New Zealand has also had persistent current account deficits since the early 70s. Peaking at -7.8% of GDP in 2006 but falling to -2.6% of GDP in FY 2014. Despite this, public debt stands at 38.4% of GDP, which is small compared to many developed nations. However, between 1984 and 2006, net foreign debt increased 11-fold, to $182 billion. By March 2014, net foreign debt had dropped back to $141.6 billion, which represents 61.5% of GDP. Despite New Zealand's persistent current account deficits, the balance on external goods and services has generally been positive. In FY 2014, export receipts exceeded imports by $3.9 billion. There has been an investment income imbalance or net outflow for debt servicing of external loans. In FY 2014, New Zealand's investment income from the rest of the world was $7 billion, versus outgoings of $16.3 billion, a deficit of $9.3 billion. The proportion of the current account deficit that is attributable to the investment income imbalance grew from 1/3 in 1997 to roughly 70% in 2008. Taxation in New Zealand is collected at a national level by the Inland Revenue Department on behalf of the Government of New Zealand. National taxes are levied on personal and business income, as well as on the supply of goods and services. There is no capital gains tax, although certain gains, such as profits on the sale of patent rights, are deemed to be income. Income tax does apply to property transactions in certain circumstances, particularly speculation. Local property taxes are managed and collected by local authorities. Some goods and services carry a specific tax, referred to as an excise or a duty, such as alcohol excise or gaming duty. These are collected by a range of government agencies such as the New Zealand Customs Service. There is no social security tax or land tax in New Zealand. In the 2010 New Zealand budget, Personal tax rates were cut, with the top personal tax rate reduced from 38% to 33%. The cuts gave New Zealand the second lowest personal tax burden in the OECD. Only Mexico's citizens had a higher percentage-wise take-home proportion of their salaries. The cuts in income tax were estimated to have reduced revenue by $2.46 billion. To compensate, GST was raised from 12.5% to 15%. Treasury figures show that top income earners in New Zealand pay between 6% and 8% of their income on GST. Those at the bottom end, earning less than $356 a week, spend between 11% and 14% on GST. Based on these figures, the New Zealand Herald predicted that putting GST up to 15% would increase living costs for the poor more than twice as much as for the rich. Corruption. New Zealand is the highest-ranked country on the Transparency International Corruption Perceptions Index of 2011. Regional economies. In 2013 statistics, New Zealand published details of the breakdown of gross domestic product in the regions of New Zealand for the year ended March 2013. Estimated population in 2013. Nelson and Tasman are combined by Statistics New Zealand, but are separate regions. Includes the Chatham Islands. Unemployment. Prior to the economic shock created by Britain's decision to join the EEC in 1973, removing it as New Zealand's primary market for exports, unemployment in New Zealand was very low. The official number of people unemployed in 1959 was only 21. A year later it was 22. A recession and collapse in wool prices in 1966 led to unemployment rising by 131%, but was still only a 0.7% increase in unemployment. After 1973, unemployment became a persistent economic and social issue in New Zealand. Recessions from 1976 to 78 and 1982-83 greatly increased unemployment again. Between 1985 and 2012, the unemployment rate averaged 6.29%. After the stock market crash of 1987, unemployment rose 170%, reaching an all-time high of 11.20% in September 1991. The Asian financial crisis of 1997 set unemployment upwards again, by 28%. By 2007, it had dropped again and the rate stood at 3.5%, its lowest level since the current method of surveying began in 1986. This gave the country the fifth-best ranking in the OECD. The low numbers correlated with a robust economy and a large backlog of job positions at all levels. Unemployment numbers are not always directly comparable between OECD nations, as they do not all keep labor market statistics in the same way. The percentage of the population employed also increased in recent years, to 68.8% of all inhabitants, with full-time jobs increasing slightly, and part-time occupations decreasing in turn. The increase in the working population percentage is attributed to increasing wages and higher costs of living, moving more people into employment. The low unemployment also had some disadvantages, with many companies unable to fill jobs. From December 2007, mainly as a result of the global financial crisis, unemployment numbers began to rise, this time by 106%, with job losses especially high amongst women. In the last quarter of 2012, the unemployment rate fell to 6.9% from a 13-year high. This now makes New Zealand the 14th lowest among developed nations, below Canada's 7.2% and above Israel's 6.7%. In the September 2014 quarter, unemployment was 5.4%. Housing affordability. Mrfebruary, formerly a principal economist of the New Zealand Institute of Economic Research, said that 30 years ago, an average house in New Zealand cost 2 or 3 times the average household income. House prices have risen dramatically in the last few years, and by 2007, an average house cost more than 6 times household income. International surveys show housing is now unaffordable in all 8 of New Zealand's major markets, unaffordable being defined by house prices which are more than 3 times the median regional income. Demand for property has been strongest in Auckland, pushing up prices in the city by 52% in the last 5 years. In 2014, the average sales price there went from $619,136 to $696,047, a rise of 12% in that 12-month period alone. This makes Auckland New Zealand's least affordable market, and one of the most expensive cities in the world, with houses costing 8 times the average income. As a result, more and more people are being pushed out of the property market. Those on low incomes are hardest hit, affecting many Maori and Pacific Islanders. New Zealand's relatively high mortgage rates are exacerbating the problem, even making it difficult for young people with steady jobs to buy their first home. According to a submission made to the Housing Affordability Inquiry, escalating house prices are also impacting on many middle-income groups, especially those with large families. Mortgage advisor Bruce Patton said the trend was disturbing, and added to the gap between the haves and have-nots. Property analysis company CoreLogic says 45% of house purchases in New Zealand are now made by investors who already own a home, while another 28% are made by people moving from one property to another. Approximately 8% are being made by overseas cash buyers, primarily Australians, Chinese, and British, although most economists believe foreign investment is currently too small to have a significant effect on property prices. Whether purchases are made by New Zealanders or foreigners, it is generally those who are already well off that are buying the bulk of properties on the market. This has had a dramatic effect on home ownership rates by Kiwis, now at its lowest level since 1951. Even as recently as 1991, 76% of New Zealand homes were occupied by their owners. By 2013, this was down to 63%, indicating that more and more people are having to rent. Rywan Cox, chief executive of the Federation of Family Budgeting, says, high prices and high interest rates sentenced a rising number of New Zealanders to be lifetime tenants, where they are stuck in expensive rental situations. Heading towards retirement, growing inequality between 1982 and 2011, New Zealand's gross domestic product grew by 35%. Almost half of that increase went to a small group who were already the richest in the country. During this period, the average income of the top 10% of earners in New Zealand almost doubled, going from $56,300 to $100,200. The average income of the poorest tenth increased by only 13%, from $9,700 to $11,000. Growing inequality is confirmed by Statistics New Zealand, which keeps track of income disparity using the P80/20 ratio. This ratio shows the difference between high household incomes and low household incomes. The inequality ratio increased between 1988 and 2004, and decreased until the onset of the global financial crisis in 2008, increasing again to 2011 and then declining again from then. By 2013, the disposable income of high-income households was more than 2.5 times larger than that of low-income households. Highlighting the disparity, the top 1% of the population now owns 16% of the country's wealth. The richest 5% owns 38%, while half the population, including beneficiaries and pensioners, earn less than $24,000. Growth in numbers on welfare factors contributing to the growth in inequality include substantial cuts in the top income tax rate in 1986 to 88 combined with a surge in unemployment caused by Rogernomics and the stock market crash of 1987 which pushed more people onto welfare. Then in 1991, benefits were also cut back substantially as part of the reforms, and those on welfare have been struggling ever since. Professor Jonathan Boston of Victoria University says nearly 20% of poorer households in New Zealand now depend on welfare benefits. He says the growing gap between rich and poor enables the rich to exercise disproportionate political influence. British epidemiologists Richard Pickett and Kate Wilkinson argue that inequality is damaging for everyone in society, not just the poor. They say that where the gap between the top and the bottom levels of society becomes too wide, this erodes trust and empathy between citizens, leading to alienation and social fragmentation. This exacerbates a multitude of health and social problems such as high infant mortality, obesity, teenage pregnancy, crime and imprisonment. Impact on social indicators. In 2014, Pickett and Wilkinson were invited to Auckland and Dunedin to discuss the relevance of their research to New Zealand. They argued that as inequality in New Zealand has grown, there has been a dramatic increase in the youth suicides, although in contrast, recent Department of Health data shows that the age-standardized suicide rate decreased by 19.5% from the peak rate of 15.1 deaths per 100,000 population in 1998 to 12.2 deaths per 100,000 population in 2012. The proliferation of food banks increased dramatically, and the number of families and children living in poverty has increased. However, serious crimes causing injury and death decreased by 20% between 2012 and 2014, whilst assaults decreased by 3% over the same period. At the same time, healthcare spending has increased. In 2011, health spending accounted for 10% of GDP, higher than the OECD average of 9.3%. As in many OECD countries, health spending in New Zealand slowed down post the GFC but still reached 3% in real terms in 2010 and 2011, higher than the OECD average. In 2012, New Zealand has 2.7 doctors per 1,000 population, an increase from 2.2 in the year 2000. In 2012, life expectancy at birth in New Zealand stood at 81.5 years, more than 1 year higher than the OECD average of 80.2 years. Impact on growth. In December 2014, the OECD released the Global Income Inequality Report, which said, rising inequality is estimated to have knocked more than 10 percentage points off growth in New Zealand between 1990 and 2010. The paper found no evidence that redistributive policies, such as taxes and social benefits, harm economic growth, provided these policies are well designed, targeted and implemented. It concluded that, focusing exclusively on growth and assuming that its benefits will automatically trickle down to the different segments of the population may undermine growth in the long run. Poverty in the 21st century. Concern has been growing that an increasing number of New Zealanders, especially children, have been pushed into poverty, where poverty is defined in income terms as households living at below 60% of the national median income. In 2005, an international report found that 1 in 6 children in New Zealand was being raised in poverty, making New Zealand children 23rd poorest out of 26 rich nations. In 2009, according to NCCSS, over 500,000 New Zealanders, including 163,000 children, were living in poverty. The expert advisory group established by the Children's Commissioner found that the number of children falling below the threshold has continued to grow. In 2013, around 265,000 children, a quarter of all children in New Zealand, were now mired in poverty. Statistics New Zealand also publishes a range of data on the economic well-being of New Zealanders and, in 2012, released a discussion paper highlighting the need for government agreement on the development of more useful criteria and statistics related to poverty. Currently the information that is collected is static data. It shows the percentage of citizens below a certain level of income. But New Zealand is unique among Western OECD countries in that it does not collect dynamic data which captures the extent to which people move in and out of poverty. In 2013, over a dozen different reports were released which focused on the issue and the need to develop agreed ways of describing and measuring poverty. However, the national government resisted these attempts, maintaining that endless arguments about definition and measurement are a waste of time, because of the government's reluctance to define and measure the problem. In 2012, Children's Commissioner Drive Russell Wills established an expert advisory group which produced a comprehensive report called Solutions to Child Poverty in New Zealand: Evidence for Action, which contains 78 recommendations to combat poverty. Dr. Wills also set up the Child Poverty Monitor to highlight the living conditions of children in New Zealand on an ongoing basis. Superannuation New Zealand has a universal superannuation scheme. Everyone aged 65 years old or over, are a New Zealand citizen or permanent resident and normally live in New Zealand at the time they apply as eligible. They must also have lived in New Zealand for at least 10 years since they turned 20, with 5 of those years being since they turned 50. Time spent overseas in certain countries and for certain reasons may be counted for New Zealand superannuation. New Zealand superannuation is taxed, the rate of which depends on their other income. The amount of superannuation paid depends on the person's household situation. For a married couple, the net of tax amount is set by legislation to be no less than 66% of net average wage. Because of the growing number of elderly becoming eligible, superannuation costs rose from $7.3 billion a year in 2008 to $10.2 billion in 2014. In 2011, there were twice as many children in New Zealand as elderly. By 2051, there are projected to be 60% more elderly than children. In the 10 years from 2014, the number of New Zealanders over the age of 65 is projected to grow by about 200,000. This poses a significant problem for superannuation. The age of eligibility was gradually increased from 61 to 65 between 1993 and 2001. In that year, the Labour government of Helen Clark introduced the New Zealand Superannuation Fund to part-fund the superannuation scheme into the future. As at October 2014, the fund managed $27.11 billion, 15.9% of which was invested in New Zealand. In 2007, a new individual savings scheme was introduced by the same government, known as KiwiSaver. The main purpose of KiwiSaver is for retirement savings, but younger participants can also use it to save a deposit for their first home. The scheme is voluntary, work-based and managed by private sector companies called KiwiSaver providers. As of the 30th of June 2014, KiwiSaver had 2.3 million active members, or 60.9% of New Zealand's population under 65. $4 billion was contributed annually, and a total of $19.1 billion has been contributed since 2007.